market was high, the money poured in. And when did the money come out? The money came out in late 2008 and early 2009 that turned out to be the bottom of the market. So what happens when you try to do that and you let your emotions tell you, because after all, what's happening is at the top of the market, all the stories are it's optimistic, everything's going to be perfect. At the bottom of the market, the sky is falling, the world's going to end. That's when people take their money out. And so I'd much rather be a buy and hold investor, and just because I know I can't do it. And I don't think anybody can do it. And the fact is, remember, when you try to time the market, you've got to be right not once but twice. You've got to be right when you get out. You've got to be right when you get back in. And because when there are reversals in the market, they happen so quickly. If you take a period, and this was done from 94 to 2008, where the buy and hold investor had something, and this was not a great time to be in the market, had a 7% return. If you had in fact just missed the best 10 days, your return got down to practically nothing. And if you had missed the best 30 days, and remember those best days typically were the leaps up right at the bottom of the market when everyone is pessimistic, you missed those days and you actually had a negative return. So I say, don't try to time the market. You can't do it. It's very dangerous. Now, not only do people make mistakes when they try to time the market because they get in at the top and out at the bottom, but they buy the wrong kinds of funds. Remember, I told you more money went into the stock market in late 1999 and early 2000 than ever before. Well, what did it go into? It went into high-tech funds. It didn't go into the value funds, which were actually very cheap then, and value stocks actually did well at the beginning of the 2000s, but it went into all of the internet stocks. You know, I remember so vividly as a director of the Vanguard Group, our flagship, Vanguard has generally had a lot of value funds. Our flagship value funds were losing assets, and all the assets were being taken out. And, you know, you sort of wonder where they were going, because when you're in a mutual fund complex and there's a redemption of a fund, it goes into the money fund. So you have to look at where the checks were written from the money fund. They were all written to this company in Denver called Janus, and they went to something called the Janus 20 Fund, which was 20 of their best stocks. They're all internet stocks. So there's also this selection penalty that money went into internet stocks and out of value stocks at the top. And again, you know, without going through all of the bars and things in there, there's also a selection penalty. There's a study that was done by a company called Dalbar. And what it did was it tried to compare the returns that are published by the mutual funds, or when you say the stock market did a certain rate of return, from how individuals fared. In other words, if let's say there's a period, and this is a period from 1988 that this was the Dalbar study to 2007, so it did go to the top of the market. This is not indicative of what the stock market is going to do in every period. You had an 11.6% rate of return. But if you look at how the average investor did, realizing that the average investor wasn't necessarily in the market at that time, that the average investor didn't buy and hold, wasn't buying at the beginning and holding all the way through, the average investor got only 4.5%. And again, that's the danger of trying to do the timing. You can't do it. It's very dangerous. Obviously, with perfect hindsight, yes, you should have timed the market. You can't do it. Don't do it. You're more likely to do it wrong than right. And incidentally, this is true not only of individuals, but for institutional investors. I have looked at the cash positions of active managers, whether they're pension funds or mutual funds. Institutional investors have more cash at the bottom and the least amount of cash at the top. Nobody can do it, neither amateur nor professional. The second timeless lesson is what I will call the dollar cost averaging lesson. Again, the argument is, and most of you who are accumulating, who are saving over time, are taking advantage of this, there is an advantage for putting money into the market regularly over time. So what this shows you is that even though the market was rising in what's to the right of the screen, you actually made more money in this volatile flat market than you did in the rising market. Now, it's not always true. The dollar, obviously, if the market is continuously rising, you want to put all your money in at the beginning. But if, in fact, we're in a situation of pretty volatile times, you're more likely to be on the left-hand side of the screen, and at the very least, you're going to reduce your risk this way, and the regret that comes if you happen to put all your money in at a market top. I'm very fond of the advice of Warren Buffett, who likes to give this quiz. So you plan to eat hamburgers all of your life. What would you prefer? Do you want lower prices of hamburgers in the future or higher prices? And you know, obviously, if you're going to buy hamburgers, you'd like lower prices in the future. Or you want to buy automobiles throughout your life, and you're not an automobile manufacturer. You'd prefer the automobiles to be lower in the future. And now for the final exam, Warren Buffett says that most people get wrong. So you're going to be an investor all of your life. Do you want higher prices or lower prices? And the answer is no, you actually would want lower prices. It's as if you're buying cheaper hamburgers or cheaper automobiles. It's only when you're close to retirement that you want to get into the safer stuff where you take things out. And incidentally, what you have actually as part of your options, for those of you who are getting closer to retirement, that's why you have target maturity funds that in fact make sure that you're not at a time at the end where everything's in the stock market when the stock market might be low, and the target funds do exactly that for you. Now, the other thing that is, I think, a timeless lesson is to rebalance, and I say yearly. My own work suggests that one ought to rebalance yearly, and this gives you an example from January 1996 through December of last year. That the bottom row says, if you were not rebalanced, you simply start off with a balanced portfolio of 60% stocks, and we'll say you're in an index fund, what is called generally a total stock market index fund, which in the Vanguard case is with the Russell 3000, and 40% the broad bond market index, which this says the Lehman. Unfortunately, it's now called the Barclays Global Index. I don't know, something must have happened to Lehman along the way. I'm not sure what it was. So if you were not rebalanced, you had an 8.75% return. And then if you just simply said, I want to be 60-40, and I'm going to rebalance every year. That's what the top row suggests. So every year, you look at the portfolio. If you're away from 60-40, you go back to 60-40. And you have a rate of return that's well over 1 percentage point higher. So why does it work? Well, it works for the following reason. Just think, you can't time the market, but let's say we're going to rebalance in January of every year. So you started off 60-40. We're now in, January of 2000. You don't know it's the top of the market. Nobody knows it's the top of the market. But what you do know is that your stocks are sky high, and the Federal Reserve was increasing interest rates, which means bond prices fell, and your bonds were low. So you might have had 75% in stocks and 25% in bonds. And so you say you take some money off the table, you take it from the stocks and put it into the bonds. You're then January of 2003. You don't know you're just after the low of the market, but what you found was the Federal Reserve had lowered interest rates, so bond prices were up. So your bonds might have been 50-55%. Stocks were in the tank, so stocks were well below your target, and so you then sold some bonds and bought some stocks. That's why this works. And rebalancing, again, if the stock market does nothing but go straight up, even then, it'll work in that it gives you much less volatility, but you won't quite get the extra return. But again, if we're going to be in volatile markets, rebalancing is going to not only reduce your volatility, but it's going to increase your rate of return. Now, the other timeless lesson that I hear all the time saying, boy, diversification doesn't work anymore. We learned that in 2008 and early 2009, there were few places to hide. Everything went down together. Emerging markets went down. The U.S. market went down. Diversification doesn't work anymore. That's I can't tell you how often I read that. Well, first of all, if you were in bonds, if you had some bonds in your portfolio, diversification did work. What we know about diversification, you get the most benefit when you buy an asset class that tends to be uncorrelated or very lowly correlated with, say your main asset is U.S. stocks. Bonds actually have become a better diversifier over time in that the correlations have actually fallen. So there were places to hide. In fact, what happened with bonds was the Federal Reserve was reducing interest rates to essentially zero, and bond prices were going up. So bonds were a place to hide. Now, it's true that all world stock markets became very highly correlated. And globalization has tended to increase the correlations among markets, but even though the correlations have gone up, it's still paid to be diversified internationally, because here you have a graph of the emerging markets in the decade from 2000 to 2010. And, it's something that people often call the lost decade, because it was not a good time. These are worldwide stocks. It was not a good time to be in the stock market. You ended up about the same place that you began, but emerging markets gave you a 10% annual rate of return. So even though the ups and downs are the same, it's the fact that, they look like they're very highly correlated, and they are highly correlated. That still didn't mean that you didn't want to be diversified, because you did much better if you were diversified and had some of the emerging markets. And again, let's sort of put these things together. The advantages of diversification, rebalancing, and dollar cost averaging. You have at the bottom of the slide the lost decade. You were in the S&P 500. You didn't make a penny. You, in fact, lost some money. And in the top part of the graph, it says you're diversified. You have bonds. You have some international stocks, including emerging market stocks. And you do a little bit of dollar cost averaging. And in the first case, your $100,000 declines to $80,000. And in the second case, your $100,000 goes up to $250,000. So it basically just gives you some numbers to go away with what I've called the timeless lessons, that by diversifying, dollar cost averaging, and rebalancing, you get a much better investment performance. The next slide, and I'll try to tell you, those of you who don't see the slides, what this shows you, is that costs matter. You know, I think all of us need to be very modest about what we know about financial markets and what we don't know. But I will tell you the one thing that I am absolutely certain of. And the one thing I'm absolutely certain of is the lower the costs charged by the purveyor of the investment service, the more there will be for you. You know, it sounds so obvious, but it is just absolutely the case. As the founder of the Vanguard Group, Jack Bogle, likes to say, in the investment business, you get what you don't pay for. And what this does is it breaks down all mutual funds, and these are not just, these are actively managed funds. This is every mutual fund there is in the United States. And it divides them into quartiles. The low-cost quartile has lowest turnover and the lowest explicit expense ratio. The high-cost quartile has the highest costs and the highest portfolio turnover. And the low-cost quartile gives you an 8.66% rate of return. The high-cost quartile gave you a 6.66%. And this is the period 1994 through the end of last year, the end of '09. So you got 2 percentage points more a year. And you know, I've done all kinds of studies for how do you pick the mutual funds that do best. The only thing that is reliably related to how mutual funds do is the cost they charge. And so the one thing you can control are the costs you pay. You want to have funds that charge the lowest in expenses. And that brings me to one of my favorite subjects, is that you ought to also use, at least to some extent, index funds, because the quintessential low-cost funds are index funds that simply buy and hold a broad portfolio and charge minimal, I mean, they're very close to zero expense ratios. Now, I've always argued that index funds make sense, first of all, because markets are reasonably efficient. You know, there are a lot of very smart people out there looking for every opportunity to buy cheap stocks, and they therefore give you a tableau of market prices that makes it very difficult to find really cheap stuff. You know, the way we academics like to tell this is the sort of story about the efficient market professor who's walking along with a couple of graduate students, and the graduate students see a $100 bill on the ground, and one of the graduate students stoops to pick it up, and the professor says, don't bother to pick it up. If it were really a $100 bill, it wouldn't be there. You know, I'm not quite that extreme. I tell the graduate student, pick it up right away, because it isn't going to be there for long. I mean, we just don't leave $100 bills on the ground very long. So that's one reason why you ought to be in index funds. But even if you don't agree with me that markets are pretty efficient, indexing still has to be an optimal strategy, because when you think about it, investing has to be a zero-sum game. That is to say, we're all different investors. We buy different stocks. Since all the stocks have to be held by somebody, it must be that if I just buy the stocks that go up the most, somebody else has had to have the stocks that didn't go up. This is just, you know, we don't live in Lake Woebegone. We cannot all be above, we can't all be above average. So if you think of it then, that if half the people are better than the market, half of them have to be below the market, you realize it's a zero-sum game, but in the presence of costs, if you now say that on average, and this is true, that on average, purveyors of investment products charge 1 percentage point in costs, that means that if the market does 8%, you've shifted the whole distribution over in that everybody's going to get whatever they got from their portfolio minus the 1% of cost. It then must be that most people will underperform the market if you could buy an index fund that has the whole market at essentially zero cost. And that's really it's a matter of arithmetic that since index funds are available at, something like right around 0.1%, essentially zero cost, it has to be that as a matter of logic, they're going to outperform most other managers. And, I look at this stuff, I said you ought to be in index funds before index funds even existed. I'm actually working on the 10th edition of my book, A Random Walk Down Wall Street. And every time I do it, and these are data that I'll put in the new edition, every time I look at it, look at the last year, look at the last 20 years, you see generally 2/3 of investors of funds are beaten by an index fund. And it doesn't matter whether it's all funds, all large cap funds, all mid cap funds, all small cap funds, multi-cap funds, global, international, even in emerging markets. 90% of active managers are beaten. And the reason that more are beaten in emerging markets, which are probably less